Leverage and margin. Simply put, leverage means borrowed money. It is commonly used to buy physical assets such as land, houses or cars. Suppose you want to buy a car that costs $20,000, but you have only 1/5 of that amount in cash. So, you go back to a bank to borrow the rest of the money, $16,000. Now you can buy the car with all $20,000 in hand. In essence, this is an example of a 1-to-5 leverage, because 1 unit of your own capital accounts for 5 units of borrowed funds. The same mechanism is used to trade financial assets, like stocks. With $4,000 on your account, you can purchase 100 stocks of Company X, priced at $40 per share. A broker offering a 1-to-20 leverage widens your opportunities. He makes it possible for you to buy 20 times more stocks with $80,000, $76,000 of the borrowed capital and $4,000 of your own. One of the major benefits of leverage is that it enables you to open larger positions with a relatively small initial deposit. Now suppose the price per share has increased by 10% up to $44. If you sell your 2,000 stocks at the current market price, you'll get $88,000 and make a profit of $8,000. 88,000 minus 80,000 and make a profit of $8,000. Alternatively, if the price goes down by 10%, you'd lose $8,000, which is twice the amount of your original investment. You see, all leverage has magnifying power. It can exponentially increase profit if the share price moves in your favor, but it can similarly multiply losses if the price goes against you. In using leverage, investors have to be aware of risks and be able to manage their exposure to them. Leveraged trading is possible on margin accounts only. In fact, to margin means to borrow funds from a broker. In the beginning, brokerages require a certain percentage of the stock value to be kept on a margin account. It is called an initial margin requirement, which usually makes 50% or more. Also, there is a maintenance margin, or the minimum equity needed to borrow funds. If the margin level drops below the limit, you receive a margin call. This is a demand from your broker to fund your account. A broker does this to protect themselves and to ensure they don't lose on a loan. Moreover, you will have to pay interest if you hold a position open overnight. An overnight fee is charged because you borrow funds rather than trade with yours.